I think hedge funds are probably more broadly distributed now than they were in the 90s. So long-term capital maybe doesn't come into it, although we were investing in hedge funds back then. But I think that people are especially in tune with the volatility now, having just been through 2008. So we're getting calls where people are trying to understand, how can I lower the volatility, how can I take some risk out of the portfolio, and how can I use various investments to help us do that.
Just out of curiosity, are your clients bothering you more to be more hands-on? In other words, does more volatility make them want to take on more responsibility, or does more volatility place more responsibility in your hands to steer them through?
I think it depends on the client, of course, but I would say as a rule, when it gets volatile like this, most people call and say, help me, just handle this, because they feel less equipped to be able to navigate those kind of markets.
So in this volatile environment, what are they looking for? What are you hearing from your clients? What do they want?
I mean, everybody's looking for yield, and so it's often that we get calls asking how they can supplement portfolios with other yield-oriented investments that are still safe. We've invested over the past year or so in some real estate, multifamily real estate, that we think is attractive and helps portfolios round out when you've got interest rates at zero. It helps people who are income generators or need income generation. So that's the kind of thing that I think they've been
And what
interested
kind of trends? Is that due to the mortgage crisis?
Well, I mean, if you think about what's happened in this country over the past few years, we have all these foreclosures. We've got, in some cases, one of my partners likes to say we have 7 million bad homeowners in this country that are going to be very good renters, and we're in the middle of that process right now. So as people are leaving their homes or walking away from mortgages, they're going to have a place to live. And at the same time, during this past 10-year period, there's been a underdevelopment for multifamily assets in the United States. So there's been a boom in perhaps the commercial markets, but not as much in the multifamily space. So it's become a very attractive asset class. And we started to talk about this a couple of years ago because we saw us entering an environment of lower interest rates for a period of time, and we were trying to think about...
So you got that call, right?
We did. We did. We're trying to think about how to supplement the bond portfolios we had, and we do have a lot of retirees, and so we tried to think thoughtfully about what we'd want portfolios to look like, and that's how we got engaged in multifamily.
So creating this kind of real estate vehicle where you create partnerships, I'm assuming they're private partnerships, that then your families, your clients can invest in, has paid off.
It's actually one private partnership, and families are investing in a series or a diversified portfolio of multifamily around the United States. And it's early, but so far it's doing what we hope it to do.
As far as alternative assets go, so real estate, so far so good, how many alternative assets demands have you seen? In other words, people interested in farmlands, people interested in water rights, some of the things that maybe you can provide as a wealth advisor, but that may not be evident to the average investor.
I mean, we've had some discussions around farmland. We've had some investors investing in some farm deals because, and it was some time ago, because it was attractive. I think this perhaps last downtrend in the economy, and perhaps China, the concern around China's hard landing, might have some of that demand.
In other words, you feel like some of that demand was fueled by commodity prices rising.
Clearly.
And so with the global slowdown, some of your clients have changed their point of view a little bit.
I think so. I think so. And frankly, we never had a lot of demand for those kind of things because it's a little esoteric and it's on the fringe. But I think that the general demand for those other type alternatives will probably ebb a little bit given the slowdown.
What are you seeing now after 30 years in the business that surprises you, if anything, about your clients' reaction to the environment?
I guess what always surprises me is investors are always very emotional about their portfolios, and they get emotional. And part of our role is to take the emotion out of it and to help them think about things on longer time frames, and to get away from, I always tell people we need to get away from the screen and get away from the television and get away from those kind of things that can distract us from the ultimate goal. Clients can do that to themselves if they're not careful.